Taiwanese index is trading in the red. It's down 0.4%.
And we need to get our head above the 19,600 level.
Q1 itself, we were close to around 1350 to 1400 value.
2 days of steep losses, finally a bit of a bounce back.
Trending up market, the time taken to research stocks reduces and the size increases.
Because if you have 2-3 months of much more elevated print, then the average will obviously go up.
Today, finally, there is some green on the screen.
Those reported net profits for the first time ever.
We haven't seen any much change in overall trends when it comes to pricing.
Reserve Bank's policies are all conducive to growth.
The EBITDA, just look at that. A 52% growth is what we've seen in EBITDA.
Weak set of numbers. So, to begin with, cost of funds have weighed on the NII front.
Well, last hour of the week coming up in terms of trade here on the on closing bell. We're coming to you from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Surabhi and Rima. Guys, hi, good afternoon.
Hi.
And,
Good afternoon.
we have
Happy
Nigel.
Friday, Prashant.
Happy Friday.
Better than good afternoon.
I started the show this morning saying, I didn't say it, Sonia, Nigel said it, TGIF. So
Okay.
we can close the show with that. Nigel is here as well. Nigel, hi, afternoon.
Well, afternoon, guys. Just an hour to go, right? So need to wind down market action and go into the weekend. And, 4 of us on the screen, Surabhi is the party girl.
Getting into other kind of action, huh?
It's just, no, that's my name all gone bad, but that's for another time. Prashant, why don't you take it away? I think market's also in a bit of a Friday mood after the slump midweek. It's not such a bad looking screen today.
It is not, absolutely. I mean, 100 points higher, there is a bit of a bounce and things are looking up and up. So it's pretty good. I mean, we basically got to the, we didn't actually enter that band. We had a bounce yesterday from between 19,200 to 19,300. That's essentially where the market seemingly has based out. I mean, for now. I mean, it's just one day, so can't say anything definitively. But I would think so. We've kind of maintained that view for the last 2 or 3 days now. So we're closer to 19,500. Very simply put, you basically need to get above the 20-day moving average for the Nifty, which is still, I think, 120 points away maybe. And on the Bank Nifty also, you need to get above the 20 days. So that's going to be the first marker which will tell you that perhaps some repair is starting to happen in a serious way. So that's where we stand. And private banks are doing well. The biggest gaining sector is IT. So those will be focus points. Market breadth, I think, is pretty positive. It's been 2:1 for pretty much most of the session today. So broader markets, mid caps and small caps, which ended higher yesterday, are doing well today as well. Rima.
Hi, that's about the index, right? Individual stocks, there has been so much action. It's the State Bank of India, very sharp NIM contraction of more than 30 basis points, the highest that we've seen in the last 6 years. The stock has taken a tumble, down 2.5% right now. And we've not seen the big earnings misses with the other banking names so far. So this one stands out. Zomato, of course, has been the stock of the day, holding on to all its gains very tight. Zomato is now up 10.5%, but it's still not quite reached its listing day. I think on listing day, the stock had crossed more than 110 rupees. So today it's at 95 rupees. So that's been one big mover. M&M numbers look strong, but the stock is still down close to about 1%. But that one too had a big run up in the recent past. That's the State Bank of India management.
Oh, absolutely. And the market really wants to hear from them because there was a miss. Remember, there's a miss on several counts. One, we have to figure out this, cost of funds trajectory, this margin disappointment that's come in, whether it's a one-off or if it's a sign of things to come, because the compression margins is a lot more than what most brokers were penciling in. And then slippages have gone up. Slippages quarter on quarter have doubled for State Bank of India. From around 3,500 odd crores, that number is now above 7,800 crores. So again, there is a seasonality aspect, particularly in the agricultural book, most of the time, most often at this time of the year, but we need to see if there's anything more beyond that agri-book seasonality. So that's, again, a piece of commentary that the market will watch out for. Margins, what's happening with slippages, and in general, cost of funds and loan growth. Loan growth was not bad for SBI, but some of the brokers were looking at numbers of 16% plus year on year. The bank has delivered just northwards of 14%, I think 14.5% loan growth year on year. So we'll see, but it's become a bit of an excuse for the stock to sell off. Nigel, what do you have your eye on?
Well, it was looking pretty okay, but, the bulls would have wanted SBI to be the swing factor on the upside. Unfortunately, it's actually the swing factor on the downside today because things were looking good. All right, I think we are getting, the SBI presser that's going to be starting. So let's cut across and hear out what the management has to say. The chairman, Dinesh Khara, is addressing the press.
They revised the global forecast to 3% from 2.8%. This actually indicates improving prospects across both advanced and emerging economies. Immediate concern about the financial stability seems to be subsiding owing to the resolution of the US debt ceiling standoff and strong action by the authorities to contain the turbulence in the US and Swiss banking. However, the recent downgrade of the US by Fitch over various concerns of the country's finance and debt burden could trigger the bouts of financial volatility with the risk of reactions from the market. Against this backdrop, I would say that Indian economy continues to exhibit stronger than expected growth momentum, with robust domestic investment providing the necessary support amidst weaker external sector dynamics. Looking ahead, real GDP growth is expected to be in the range of 6.5%, aided by the government's thrust on infrastructure spending, traction in domestic demand, revival in corporate investment, and healthy bank credit. Headwinds from prolonged geopolitical tensions and slowing external demand are the key risks to the outlook. On the banking front, credit growth has continued to grow in double digit and became broad-based across sectors. During Q1 of this financial year, all scheduled commercial banks' credit has grown by 16.2% and aggregate deposit has grown by around 12 to 13%. As demand for credit continues, we expect credit and deposit may grow up by 14 to 15% in financial year 24. In the backdrop of this economic environment, I would like to place before all of you the highlights of the bank's performance in Q1 of financial year 24. I am pleased to announce that for once again we have recorded the highest ever profit, and also this is something which is a matter of pride for us. It may not be out of place to mention that very often there is a tendency on the part of the analyst community to really evaluate the performance in terms of quarter on quarter. We have to be very mindful of the fact that the Q1 is always a unique quarter because of the two reasons. Invariably in the last quarter we have sufficient earnings. Various one-offs are there which are getting recorded, whereas in the first quarter those benefits are not available. Secondly, when it comes to asset quality as well, when we reckon the stress or NPA or SMA, they are at a point of time. Whereas the fact of the matter is that at a point of time there could be a deterioration, but overall the recovery keeps on happening every day. For instance, in the current instance also, when we look at our SMA 1 and SMA 2, which is actually stress is somewhere around 7,000 odd crores. But if we look at it at the end of the month of July, we have already recovered 1,500 crores out of that. So I think to that extent, it is very material that we should actually evaluate YOY performance in the first quarter as compared to the first quarter of the previous financial year. So in that context, we have posted the highest ever quarterly profit of 16,884 crores. Net profit for this Q1 has increased by 178% YOY, with operating profit at 25,297. It has increased by 98.37% on a YOY basis. ROA of the bank for Q1 has improved by 74 basis points and it is at 1.22%. ROE has improved to 24.42%. Most other core profitability metrics have also improved sequentially as well as on a YOY basis. Net interest income for Q1 increased by 24.71% on the back of improvement in yields and continuing credit offtake. Domestic NIM stands at 3.47%, and it becomes all the more relevant in the context of our bank because our international book is just about 5 lakh crore, 5 trillion, and our total asset side is about 33 trillion. And also, when it comes to international book, we are very, very mindful in terms of the evolving global economy and the kind of stresses and strains which are evident in the global economy. So that's the very reason why our domestic book has grown almost at about 15% plus, whereas the international book has grown little lower, and that is a very, very conscious effort on our part. When it comes to operating expenses, they have increased by 23.68%. We have actually started building provision for the wage revision, and we have started building provision from the month of November onwards of the previous financial year, and that is the reason why it looks little on the higher side. But if you really look at it, the cost to income ratio, we are just about 50%. On the business front, the credit growth has been robust across all the segments. Domestic advances, as I was indicating, it has grown by 15%, comprising it's a very broad-based growth which we have witnessed. Retail advances have grown at 16% plus, and corporate segment grew almost at about 12% plus. SME and agri segment have posted handsome growth of 18% plus and 14% plus, almost 15%. Domestic deposits grew almost about 12%, driven by the growth in the current account and the term deposit. This is a general phenomena which we normally witness. When the inflation is on the high side, normally the money moves from the savings bank account to the term deposit, and the same behavior we have seen. And the current account growth is essentially attributed to the fact that we have started focusing on the non-government current accounts, and happy to share with all of you that even in the month of March as well as in the month of June and even in the month of July, we have been growing at a decent pace. It is much higher than any of the competitor also. So, which very clearly means that going forward it will have an impact on the composition of CASA in the days to come. With regard to asset quality, our gross NPA ratio has come down by 115 basis points YOY, and it stands at 2.76% and continues to be at its lowest level in more than 10 years. Our net NPA ratio has also declined by 29 basis points and stands at 0.71%. Slippage ratio has improved by 44 basis points YOY and it stands at 0.94%. Consistently improving asset quality is also reflected in our credit cost, which stands at 32 basis points and has improved by 29 basis points YOY basis. We have a well-provided stress book. PCR is showing an improvement by 23 basis points. It is at 74.82%. It actually went up by 127 basis points on a YOY basis and stands at, if at all we include OCA, it stands at 91.41%. On the restructuring front, our total exposure under COVID Resolution Plan 1 and 2 now stands at 22,000 crores, 22,666 crores, as at the end of Q1 of financial year 24. The restructuring book has actually behaved very well. Even if we reckon the SMA 1 and SMA 2 in the restructuring book, it stands at only at 11%, whereas if you recall, we have already kept a provision of 30% for this book, and going forward we are hoping that it will even behave even better. SMA 1 and SMA 2 does not necessarily become the NPA. This is nothing but a reflection of some kind of a stress on the cash flow for this kind of a book, but we have invariably seen that a significant portion of SMA 1 and SMA 2 gets recovered and it becomes a performing. The broad trend which I indicated, that out of 7,200 odd crores, 1,500 crore we have already recovered within a month of the account turning the stress account. So that's the kind of a situation. When it comes to the capital adequacy, the bank remains very well capitalized and we have sufficient headroom to take care of the normal business growth requirement. We have worked out that based upon the current capital adequacy, we are very well placed to support the further loan book growth to the extent of 7 trillion. Digital continues to be an important customer acquisition engine for the bank across the asset as well as the liability product. During the quarter, we have sourced 63% of savings bank account and 35% of retail asset accounts digitally through YONO. We have recently launched YONO for Every Indian, in which customers of other bank can now access experience of seamless UPI journey on YONO. Our subsidiaries have consistently performed well and continue to create significant value for all the stakeholders and most importantly for the customers of the bank. Most of our subsidiaries are leaders in their respective segment, and we will continue to nurture these subsidiaries and see them creating value for their own shareholders as well as the shareholders of SBI. Before I conclude, I thank you all for your continued support to the bank. We consider it as a privilege to be able to contribute towards the growth of our economy. We remain committed to rewarding your trust in us with superior sustainable return over the long term. I wish everyone the very best. The floor is now open for all your questions. Thank you.
Louder. Session, we will move from left to right, allowing everyone an equal chance to ask a question. You may raise your hand and ask a question using your name and the media house you are representing. We request you to please follow the format and restrict yourself to 2 questions focused on the bank's business. If time permits, we may request the circuit for additional questions.
Can somebody use the mic, please? I mean, you people can use the mic. Yeah.
Left to right, you said, no? Lalit?
Who's left?
That's right.
He's left.
Who's left?
He's left.
You mentioned.
Anyhow, please go ahead. I think you have seen perhaps it has been a trend in the banking industry. All other banks have also witnessed, and as far as we are concerned, the drop in CASA for us is much lower as compared to what the competition has seen. Not as of now. Sorry? It is 3.47% domestic NIM. I hope so. Because if you look at yield on advances and our cost of deposit, I think it should be stabilizing around this level. Sorry? I'm unable to hear you, please. Recoveries we have affected recovery of about 1,200 odd crores, whereas last year around the same quarter, this was 500 crores more. And the reason behind is at that point of time we had some reasonably higher value of recoveries. Now the stock left out is not all that big in number, and that is the reason why what recoveries are being affected. It may not really look as high as we have seen in the previous years because the chunky numbers are not there now. Sorry? Credit card book? No, credit card is a separate entity. It is not in the main bank. But as far as the credit card is concerned, even there also they have made adequate provisions to take care of any potential delinquencies. So I think there is not much of a challenge there. In terms of, so long as the book is well protected, it takes care of the requirements of that industry. See, when it comes to asset quality, I would like to mention a couple of things. One is the underwriting, which I think we have strengthened our underwriting mechanism quite well. Second comes more so when it comes to retail. The very important component for retail is underwriting is very important. It should be essentially loan management system, which should be underwriting, which means that hardly any discussion on the ground, so that people should not deviate from the underwriting principles. The second component, which is very important for the retail in particular, is essentially in terms of the control and follow-up. And we have very robust control and follow-up mechanism, and that is the reason why I could immediately relate with you and say that out of 7,200 odd crores worth of slippages, we could pull back about 1,500 crore. So that is nothing but the effective machinery on ground to make the recoveries. So I think we are seeing very good results. So I would say that on these two counts we don't have any challenge. Now when it comes to when you look at slippages, in our case the slippages are not as much coming from the running accounts, and even for that matter, even stock of our stress portfolio has also come down significantly. Corporate does not have anything, SME does not have anything, retail does not have anything. Only slippage has come from SME and agri, and there also we could pull back a significant portion. So I think it's a function of the economy on ground, and I would say that the cash flow disruptions lead to some kind of a disruption in the repayment timing. But more or less, I would say that there is, in terms of quality, it's a much better quality, and in terms of the portfolio.
First thing, sir, I would like to ask about the credit growth guidance which you have given about 14 to 15%. You have already grown 13%. What gives you confidence?
Actually, 14 to 15%, I would say that though it is looking at 13.90, but for all purposes, it is actually 15% plus. Reason behind is that our international book, we will be very selective. We may not grow as we will be growing in the domestic market, for the simple reason that the international markets are very, very choppy, and we will be really growing in those markets if at all we can take care of the quality of the risk. Yeah,
So
please.
any sector specific, if you can give idea where you are seeing the growth, and also the distribution between corporate and retail.
I think more or less now, as the situation stands, we are somewhere around 60% as far as retail is concerned. So we will be evaluating the opportunities. If at all there are opportunities for growth in corporate, we'll be more than happy to support it. We don't have a constraint in terms of the funds. We have got enough funds available. Even today also we have got excess SLR to the extent of about 4 trillion. So if at all opportunities are there and it meets our risk appetite, we'll be more than happy to support.
One question regarding NIMs. That has been one of the points which has been raised by the analysts, although you have mentioned that one should not look on quarter. But what has been the reason behind the decline?
See, reason is, if at all, I would, last quarter of the previous year, we had about 850 odd crore worth of interest coming on the income tax refund. So these one-offs are the one which are normally seen in the last quarters. So in fact, in this quarter, we don't have any one-off.
Okay, well, that's the SBI chairman, and we'll go back to it as more clarity and more comments about the future come through. 2.6% lower, stocks at about 575. We'll take our first commercial break here. Prakash Diwan will be with us, and so will Mithun Aswath on the other side. Stay tuned. Those gentlemen join us in just a bit.
Welcome back from one big earning to another. The next stock on our radar, of course, has to be Mahindra and Mahindra. Came out with numbers. There was commentary, of course, on the business, as well as I think a lot of time was spent on discussing their stake purchase in RBL Bank. Sonia has been listening into all of that. Sonia, so what's the takeaway? Numbers and the commentary?
Okay, so on the numbers, right, very strong set of numbers, much better than what the street was estimating. So there was definitely a positive surprise there. It was a top-down beat. The margins were very strong. Margins went up 240 basis points year on year, a revenue growth of 23%, and all the numbers will be up for you on your screen. Both the farm equipment and the auto business saw a margin expansion this time around. Farm equipment margins went to 17.5% versus 15.9%, while auto business EBIT margins went up to 7.5% versus 5.3%. But all eyes, as you suggested, were on what they would say with respect to the RBL Bank investment. And in that context, they said that at this point in time, they don't look to raise their stake further in RBL Bank. They will look at it at some point if it is, if it makes for a strategic fit. Their capital allocation framework is unchanged at the moment, and they saw an opportunity with an attractive valuation. It is a good bank, and they hope to, move in that journey, in the sense, take Mahindra and Mahindra Finance ahead with that journey. The investment, though they've made, is based on a long-term view of around 7 to 10 years, so they're in it for the long haul. But at this point in time, they will stick with this 3.5% stake buy and are not looking to raise it anytime soon. Back to you.
Sonia, thank you very much for that. They also go on to say the primary purpose of this investment is to understand banking. And, I've got so many forwards which say that's a very expensive tuition fee.
Exactly, 400 crores to learn a bit about banking.
So it's been called the tuition fee.
You could use ChatGPT or all the other internet resources, perhaps.
Okay. But anyway, let's listen into what the management had to say. Anish Shah, the MD and CEO of Mahindra Group, had to say on the RBL Bank investment in their Q1 presser.
This investment is really for us to understand banking in a lot more detail with a very long-term view. This is a 7 to 10-year view. There are no assumptions on our part today whether we want to get into a bank or not. In fact, at this point in time, we cannot and we do not want to. There is no intention of going further beyond this at this point. At this stage, we do not expect to go higher. At some point in future, if there's a very compelling strategic reason, which we will have to understand in detail, evaluate in detail, in line with our capital allocation guidelines, we will look at it at that point in time.
Well, Prakash Diwan joins us on the show as well. Prakash, good afternoon. What do you make of the numbers? They look very, very good. And, Rima and Surbhi, they were just talking about the tuition lesson. It's been quite an expensive one, right? It's not just the few hundred crores that they're paid out. Their market capitalization is down by close to $1 billion odd. What would you make of the company now? Operationally doing well, capital allocation suddenly has become a bit of an issue.
That's right, Nigel. So I don't think even after this stellar set of numbers, the stock has recovered the damage that the RBL adventure cost them. So, so it's going to take a while. Capital allocation decisions are more indicative of a structural change in the thought process of the management. So, it's not something which people would expect to be reversed in a hurry or in a very short span of time. So, we've seen that happen, the SsangYong misadventure of sorts, and then, how they got out of it. So that's always a little bit of a concern. But the numbers is what you need to focus on, because if there is a change in the underlying business environment, and they could probably use that to kind of grow, a lot of the mistakes could get glossed over. So from that perspective, it looks promising. In the last 9 quarters, I haven't seen these kind of margins from the automotive business, which has been a little bit of a struggler of sorts for them. Farm equipment, they've seen this sparkle come even earlier. But I keep on talking about this, and that's why Mahindra has not done so well between these 2 quarters, because the competitive intensity is what's kind of gradually creeping up. Tata Motors on the EV side fights them very fiercely. You have SUV fight, the market share fight from Maruti. And then, of course, on the other side, you have a Scotch Kubota on the farm equipment. So all of that fronts is what they're fighting. I hope they recover quickly out of all of these RBL kind of issues and get moving. But otherwise, yes, good set of numbers. The market won't kind of price this very positively because it's already run up quite a bit.
Prakash, what have you made of the rally in Dixon over the last 2 days? While undoubtedly there are a lot of structural tailwinds, for manufacturing companies in India, and this is a long-term play. But laptops, the entire manufacturing of laptops in India is still a very small portion right now. So do you think the 15% run-up is justified on the potential over the future? What have you made of this rally? Is it a bit overdone?
No, absolutely. So without stating as much, you already indicated, if there is a change in the import duty structure for laptops and, handles and personal computers, and if assuming Dixon starts making all of that, will the EPS increase by 15%? And the answer is not really, because it will be a small segment of what they do overall. And within that, there will be, also competitive issues related to pricing and margins and all of that. So it's not so easy just because you start producing. What it does is it tells you that there is an opportunity that's emerging, and that will benefit the entire ecosystem and not just one or two companies, Rima. So I think it's definitely overdone. The market loves to, work on themes or triggers which sound very simplistically promising. This is one of them. I don't think there's going to be any significant change, only in favor of just a few companies or one company. So Dixon has enough things to handle, to grow into, and they have been doing well in terms of recovering on some of those counts. But this is not something which is attributable to this 15% kind of a.
Okay. Point taken, Prakash. Thanks very much for joining us. Great having you with us here, as always. So that's the view coming in on Dixon. Well, Mithun Aswath is with us, managing partner at Kiva Advisors. Mithun, good to have you with us here. Good afternoon. The market is repairing itself after that 350, 400 point fall over the last 2 days. You think, we can kind of pick up from where we left off 2 days back in terms of the overall trend, or is going to get a little more muddled, maybe more sideways from here on? What's your sense?
Yeah, good afternoon, Prashant. I think, the last couple of sessions, we saw some pullback, primarily because of what's happening in the US bond market. You saw yields go up, crossed 4.15 on the 10-year, and even the 30-year yield went up after, the downgrade by Fitch, as well as I think the US Treasury announcing quite a lot of bond issuance. So that has some people ruffled about how yields are moving. But I think on the Indian context, I think the results have been quite strong across the board, and that is keeping stock-specific opportunities quite open across sectors. Also, I think near term for us, I think the RBI policy on the 10th of August will be something that one needs to wait for, just to see whether the RBI is ruffled by what's happening globally on the vegetable prices locally, and if they provide us guidance that they will see through this bout of vegetable inflation and they see things are okay, that should calm the nerves of investors.
Okay, Mithun, hi, good afternoon. Well, we've been getting some good news, at least today, from the internet companies, right? Zomato's finally hitting that profit mark, 2 crores, and it's actually net profit, not adjusted profit. What's your take on this entire space, your internet platform companies? It's been quite a learning lesson over the last 12 months or so, but stock prices have also moved up, Zomato included. Would you, be interested in this part of the market?
Yeah, good afternoon, Surabhi. I think on the internet space, the only, obviously Zomato has shown improvement in numbers, and commensurately the stock has reacted. However, longer term, we think, Policy Bazaar or PB Fintech is one of the companies that, uses the internet to acquire business. And we think it has a good moat and a profit model, which could be durable over the next few years. So that is something that we've invested in. We also like, companies like InfoEdge. That's another one which I think is well placed. They obviously have investments in, the companies that I talked about. But I'm beyond these. I'm not too sure that we are too positive on anything else at the moment.
Have you been buying any other stocks? You've spoken about PB Fintech in the past and how you like it. I remember in our last conversation, you spoke about some auto ancillaries and auto OEMs like Tata Motors and Eicher Motors. But what has caught your attention in the last 1 month? Anything on the earnings front where there were positive surprises?
Yeah, I think, I think earnings obviously for financials have been very strong. Also, you've seen spaces in the auto side where, they've reported good numbers. What we are actually seeing is, I think over the next few quarters, you will also see pockets like textiles, where the inventory levels are quite low in the US markets. We'll also see ordering pickup. That is what we sense from our conversations with garmenting manufacturers and other textile companies. So we could see a second half where their operating leverage could kick in, and some of these businesses where expansion of capacity has happened, they will start delivering good numbers. So that is one pocket which looks interesting. Apart from that, in the last few months, we were looking for certain segments of the market which have still not participated. One of the companies that we liked and we think it's a structural opportunity for the next few years is United Spirits. This is basically a subsidiary of Diageo. And the company is embarked upon, focusing on the premium end of the market. So they call it the prestige segment, where they are looking at that business growing, at about double digits over the next few years. And in last fiscal, they exited some of the popular brands and are focusing only on the premium segments. That should drive profitability as well as growth. So that is something that we like. The company has done admirable, things on the balance sheet. The company has become debt-free. The company also had accumulated losses, which are over now, so they can start with a dividend policy in the coming year. So I think that is a good structural play, and someone with a 3-5 year horizon should definitely reap rewards.
All right. Hi, Mithun. We'll discuss and we'll analyze, I think, United Spirits and its products in the next few hours in further detail, I think. So hope you're going to do the same as well. But for the time being, I wanted to ask you about a sector that suddenly seemed to be making a comeback. That's the real estate space. Would you approach this theme? And there are different ways of approaching it, right? You could go by the core real estate players or building materials or maybe the financiers. Your view on it?
Yeah. Afternoon, Nigel. I think, this space as real estate has done well over the last 12-24 months, with rising incomes and, price affordability being good. I think we've played it primarily through the building materials space, be it paints or, sanitary ware manufacturers. That's the way we've approached this. Even cement companies, for example, provide you an opportunity. Apart from that, the only one real estate company that we have is Prestige Estates, where, this was mainly a Bangalore-based company, but embarking on a large expansion even in Mumbai. So I think, it continues to be promising. I think growth remains quite robust, but focus more on the building material and ancillaries rather than, pure play real estate companies.
Mithun, thank you very much for joining in. Enjoy your weekend. We'll slip into a very short break. We'll come back and get a check on what dealing rooms are saying in our segment D Street Chatter. We'll also get you a few BTST calls. Stay tuned.
Welcome back to Closing Bell. Well, the markets are at the high point of the day, so the SPI numbers were a bit of a dampener, but the bulls have quickly picked up themselves, and in fact, there are a couple of stocks that are doing well. HDFC Bank, that large weight in there, that's helping the Nifty Bank move to the high point of the day. And the other one is Reliance Industries. Both those two, they are heavyweights. They move to the high point of the day, and that's what's helping the Nifty as well as the Nifty Bank as well. Nifty Bank, by the way, is up close to around 430 points as we speak. But it's a good time to move to D Street Chatter. Nimesh joins us. Nimesh, what are you picking up today? Finally a good day.
Finally a good day and a good end to the week as well. And again, but if you see the commentary or the feedback that I was getting for the last many days, even when the markets were falling, that this is not led by large FI selling.
Yeah.
And that showed in the numbers as well. Yes, the FI buying has slowed down a bit, but there are not big sellers in this market. Again, in today's state, the feedback is that the buys is positive. And now the leadership seems to be back. So Pharma was leading this rally. Now banks have joined in today's trade, and also some of the technology names seems to be bouncing back very sharply in today's trade. So that's the overall feedback, that there is a bit of leadership now. Even the midcap, which was not falling in this falling market in this entire week, even they have seen a bit of a pullback in today's trade. So looks like the momentum seems to be back with the bulls, and now it looks like, from a technical point of view, this 19,200 can act as a very strong support. That's been the key feedback, that watch out for 19,200. At least for now, it looks like that's holding as a very strong support for the Nifty.
Well, that's right, and the bulls would like to extend this run to the 20 DMA, and then in fact have a bit of a breakout on the upside. But Nimesh, individual stocks, and that's really been the theme. Tell us, what are you picking up today?
Sure. So in terms of individual names, the first stock on my list is Inox Wind. This stock has been a big mover this year, but now I understand there's going to be a large block in Inox Wind very soon, so that's something to track in that particular stock. So that's the first one. The second stock is LIC Housing. Abhishek spoke about a city upgrade as well in the morning. The numbers were quite good, and it was backed by some large buying as well. So it looks like some bit of buying is back in LIC Housing from the larger institutions. That's the second one. The third stock is Delivery. Again, part of the entire platform basket, which is doing good today on the back of strong numbers from Zomato. In Delivery for the last couple of days, the feedback is that some long only fund, maybe a large sovereign fund, is an active buyer, and that's showing up in delivery volumes, and that's the reason why a big move in that stock in today's trade. And the last one is Moil. Again, buzzing in trade, no specific news, so to speak, but I understand the flows are quite strong at HNI desk, and some large HNIs seems to be quite active. So again, the entire PSU basket has done well, and now people are looking for recent underperformance to do well. So a bit of catch-up looks like in Moil as well today.
Okay, thank you very much for that. Aditya Birla Fashion, just pull up that stock. It's tanked post its numbers. While there is a revenue growth of 11% on a year-on-year basis, there is a big loss of 141 crore on the bottom line. Margins too have fallen from 16% down to 9%. Aditya Birla Fashion, the branded apparel company from the house of Aditya Birla, see that stock fall post the numbers, now down close to about 7%. Mitesh Thakkar is with us now. He's going to give us a few BTST calls for the weekend. Mitesh.
Good afternoon. On the stock side, I would recommend Wipro as one of the BTST calls. I think IT names have been doing well, and some momentum is observed over there. So keep your stop below levels of 406. Look for targets of 414 to about 415. And the other one which I like is India Cement. That's also a stock which is gaining some traction. So BTST here with a stop at 221 and a target of around 230 on India Cements can be looked at.
Okay, got that, Mitesh. Thank you very much for the trading calls today and through the week. Hope you have a great weekend. We'll see you again on Monday. Let's take that break. We'll come back and get you the final 10 minutes of the week's trading action.
Okay, markets holding on to 19,500. So let's turn our attention to the macro since the market gains are very much intact. Close on the heels of the US 10-year and the 30-year bond yields shooting up above the 4% mark following the downgrade of the US rating by Fitch. Billionaire investor Bill Ackman adds fuel to the fire by saying he's shorting US treasuries because he thinks the yields ought to go much higher. Ackman is widely followed by fixed income investors. So why does Ackman expect yields to rise more? Lata joins in with the details. Lata.
Well, as a hedge fund investor, Bill Ackman is actually followed by fixed investment investors. And the interest is more because of the Fitch downgrade and the shooting up of yields. But what Bill Ackman is pointing out is exactly what Fitch pointed out to. Why does he see long-term US Treasury yields, that is 10-year and 30-year, more important, above 5%? He sees it at 5.5%. He gives a few reasons. One, he says long-term US inflation will not come to 2. It will remain at 3%. And why? That's because deglobalization means everyone is making in their own home. It becomes a little more expensive, many of the things. US defense expenditure is shooting because of geopolitical reasons. Energy transition has its own costs, at least initial capex. And then he goes on to say workers, because there is, the beverage curve. For every one worker, there is 1.6 jobs available. Worker bargaining power is leading to more salaries and therefore higher inflation. That's one set of reasons. The second set of reasons is the demand and supply of US treasuries, US bonds. He says there's 32 trillion accumulated debt, plus, as Fitch points out, for the next 2-3 years, given the entitlement commitments, the US is likely to run a higher fiscal deficit. That means the supply of bonds are going to increase exactly at the time when the Fed has already said it is going to reduce its balance sheet. Every month, $90 billion of bonds are not going to be bought back by the Fed when it redeems. So the one big buyer less in the market and more bond supply by the supplier, that is US government. That's the second reason. Third reason, the usual global factors. China also is decoupling. Everyone's trying to make in their own homes, so global productivity falls and product prices increase. And the big one, Japanese yield curve control is slowing. I mean, they're allowing yields to rise a bit. That's a lot of investors who would have invested in US bonds now migrating back to their own country because they are getting higher yields. That also will mean one buyer less, one big buyer less for US treasuries. And together, he calculates if it is 3% inflation, long-term yields must be at least 0.5% more than inflation. So real rate should be 3.5. Plus, there is a term premium, when from the short term to the long term, because, again, the demand-supply issue. Plus 2 percentage points. He says the 30-year should be 5.5. Today, it is at 4.25. So he has sold those bonds, expecting that yields will rise and prices will fall.
Okay, well, it's very interesting. And Bill Ackman, as Radha pointed out, is followed by fixed income and, of course, by equity investors as well. Yesterday, when the comments came through, some tried to put what Warren Buffett said. I mean, and the quote will come up on your screen. He was asked by the CNBC correspondent in the US, and this is what he had to say. He said that there are some things people should not worry about. This is one. He was talking about credit worthiness of the US. The point is that, and Bill Ackman later clarified on Twitter, he said that, well, actually, it's no disagreement. Because for Buffett, when he says that he would bet on bonds and buy bonds right now, even as Ackman is shorting it is cash management. I mean, he's got businesses running, cash is coming in, and this is purely sort of cash management to that end. So his views with Buffett in terms of the overall kind of situation, the debt situation, and servicing of it over long periods of time he does not disagree. So I think that was interesting. Many tried to kind of pit Ackman versus Buffett on this entire issue, which perhaps it was not. Well, I think we're just, 2 minutes away from the market close. We're up 128 points. This is going to be a good one. 19,510 is where we will finally end at. I just want to highlight, one group of stocks, and I'll toss it to Rima, Zomato, right? But not just Zomato. Zomato is a strong gainer today on the back of earnings. Standout. Policy Bazaar gains, maybe in sympathy. And then you got Delivery, which also stood out with very strong gains and very strong volumes. So that's Zomato, Policy Bazaar, and Delivery. PB Fintech ends up 7.5%, and Delivery ends up 5.5%. So it lit a fire under many of these sort of new age digital companies. Rima.
And you should add InfoEdge. InfoEdge ends with a gain of 7.6% on the back of its holding in Zomato. So InfoEdge was another stock on fire. Let's quickly run you through the large cap gainer. Cipla was your top gainer, up close to about 4%. HDFC spiked up. That rallied close to about 1.5%. In fact, most of the private sector financials had a good day. IndusInd Bank with a gain of 3%, Axis Bank up 1.7%. We spoke about HDFC Bank, but on the other hand, State Bank of India, that slumped as the slippages practically doubled. The net interest margins came under pressure, and the street is disappointed with the Q1 numbers. IT had a good day with the Nifty IT index rallying more than 1%, and individual names like Tech Mahindra, Wipro rallying. In fact, Tech Mahindra has been the biggest Nifty gainer in this week. This week, Tech Mahindra has seen a rally of close to about 7.5%. On the losing side, you had M&M also under pressure, down 0.5% despite a good set of numbers, and softness seen in Bajaj Auto and Maruti.
Well, on the mid-cap screens, lots of action on the upside as well. You guys have mentioned the internet companies, but even beyond the internet, quite a few interesting names. Remember, Jyoti Labs numbers are very strong in this quarter. There's some follow-through buying that happened today, 7% up on that stock. Castrol India up and about. Some of the tire stocks had a great session. MRF, for instance, 3.5% up. LIC Housing Finance was a solid show today, 8% up on that one stock. Dixon added some more weight, 3.5% on prospects of perhaps a big opportunity in terms of manufacturing laptops in India. So these were some of the stocks that were up and about. In terms of losers, not to end on a sour note, but need to point this out also, Mahanagar Gas was probably the big disappointment. Despite what looked like a pretty good quarter, there was some profit taking on that stock, 5.5% down. Radico Khaitan, good numbers, but again, more profit taking coming through. But overall, we are ending with solid gains on the mid-cap screen. The Nifty up 127 and a close once again at the end of the week above the 19,500 mark. Okay, so that's the tally for today and for this week. It's a wrap from the entire Closing Bell team, but don't go anywhere because our Friday special, Smart Money, is coming up next with Sonia.